Welcome to this week's series of Credent Connect. And today I want to cover the events and market activity, economic activity of the first half of 2026. And not necessarily just on a standalone basis, but how does that compare rather to our own view of 2026 that we released in December of 2025? If you recall back then, we often joke of what does your crystal ball say looking into 2026, right? We do this every year, and it's less about making capital market assumptions and expectations, and more so of defining the general structure of how we view the markets, how we view the economy. Are there recession probabilities? What are the markets likely to do from a behavioral and directional standpoint, not an actual absolute number? And the reason for this Credent Connect in today's structure is assessing our thinking heading into 2026 through the end of the year here in the second half, right? Because if we were completely off the ball in the first half of 2026, it would cause for a pivoting, right? A restructuring of that viewpoint heading into the second half of the year. And I'm happy to announce that is not the case whatsoever, in that how we approached the first half of 2026 from an asset allocation standpoint, from a risk backdrop, from a probability of downside across markets or the economy, proved to be very beneficial rather for aggregate client returns across our investment platform. And I'm not going to walk through all these one by one, but I do want to touch on some general highlights on each one of these sections, which are broken down and segmented by what we were increasingly optimistic with heading into 2026. Where are those things where we're kind of neutral on? And then here at the bottom, kind of assessing what are some of the things that are risk and uncertainty, right? Just highlighting that there at the bottom, risk and uncertainty of what do things look like from that standpoint. So as we look at the increasingly optimistic components, right, you'll see that the term geopolitics stands up there in that second slot in increasingly optimistic. And you're probably thinking geopolitics has been terrible for the year, right? There's the Iran war, there's further tensions in the Middle East outside of Iran, and so on and so forth. And although we recognize that going into the first half of 2026 and through this year, what's critically important to note if you were to read that is that the spillover effect to capital markets is not likely to pose additive threats. So when we were thinking about geopolitical tensions, the fact that they're going to be there, check, absolutely. But where we actually stepped back and said, what is that likely to do to capital markets? Equity returns, fixed income returns, commodity returns, volatility of everything associated with that. We nailed that particular call in ensuring that we remained allocated appropriately to capital markets, because as we noted, the short-term spikes in volatility to commodities absolutely transpired, right? If you saw oil went from roughly $60 up to 110, 120, then right back down. The commodity volatility absolutely happened, but the spillover effect into equities, into US large caps, US mid caps, US small caps, international developed equities, that did not materialize. And I bring this up as a very important point because geopolitics is going to dominate the headlines, even more so, I believe, in the second half of 2026 than the first half. But that spillover, that impact, the ability to get out of the market as a result of that is not likely to be any more dominant than it was in the first half of 2026. So from that standpoint, tremendous value there in kind of assessing that and kind of going against the grain in that risk management backdrop. When we look at oil and energy in general, oil and energy are also up top there and are increasingly optimistic space, but they're up there more so from the energy demand backdrop, right? When we looked at the 2026 from a longer term perspective, one of the things we assessed was that the thematic investment opportunities that will be generated as a result of more energy usage, more energy requirements for these massive data centers. And as the AI, that alternative infrastructure, artificial intelligence rather, infrastructure further dominates the markets, the demand for that is going to be substantial, create a tremendous investment opportunities there, and we continue to take advantage of that. Heading into that neutral piece, I'm very happy to say that we hit that nail on the head on all of those individual components in terms of how we assessed and structured risk heading into 2026. equity market participation being a dominant theme in that. And although we said that our initial view was likely low single digit returns across capital markets as a baseline in terms of assessing historical norms, where we actually pivoted to be a tremendous positive is playing on the narrative of this broadening of returns, right? This idea that it's not just those top names in the S&P 500 that are actually going to perform well in 2026. It would be the broadening of individual assets that has actually transpired in a very meaningful way. What this means for investment allocations and investment strategies is that we are taking less of a market cap approach. We're taking more of the average stock across the valuation structure, not focusing on the top names only. And by employing those individual components, right, and then employing the risk management backdrop that works so fantastically well, in addition to the tax management component of the strategies, that has panned out extremely well. We do stand ready to take advantage of the second half of 2026 if we start to see growth in the broader economy start to slow down a bit, right? Not stop, but more slow down. We are going to pivot there to maybe going back to more of a market cap structured approach to take advantage of those growth names. Secondly, what I want to point out on that neutral piece here, as we were thinking about the view of 2026, and then as we're thinking about the second half here, as it relates to bonds, right, or the fixed income environment, the fixed income capital market. One of the things heading into 2026 that we were adamant about, right, where we were writing about it and being very vocal on, is this notion that bonds will carry more risk than stocks heading into 2026. And in fact, for those that have been following these videos and our commentary and have been clients for the past 3 to 4 years, that's been the same message of the past 3 to 4 years in that bonds carry more risk than stocks. And it's not an idiosyncratic individual risk, it's more of a macro risk, right? What's going to happen to interest rates? And in the late part of 2025, the narrative was this groupthink, this conventional wisdom idea that interest rates were going to drop substantially throughout the year as a result of a slowdown in the economy, which we also said is not likely to happen in 2026 at any scale that was anticipated by the so-called pundits or talking heads. What that has allowed us to do rather is shrink allocations to fixed income and bonds to the lowest possible allotted level we could for each individual client within their specific management style, and actually invest those assets in equities in a very lower beta manner, in a very meaning lower risk manner, right? Because the reality is bonds are there to protect on the downside from equity markets. Yet if they carry more risk and capture similar downside stocks on a trend basis, not on an absolute basis, that derails the need for bonds. And so this idea that interest rates are going to drop substantially was false. We did not play into that narrative. And as we're heading now in the second half of the year, we are in fact going to consider increasing what's called duration, increasing the availability, or rather enhancing the probability of capturing a greater return profile in bonds, unlike what happened in the first half of 2026, where we played that card very conservatively and actually generated a return profile that outpaced the broader indices on the bond side. So the neutral piece of our assessment proved to be extremely worthwhile. It focused the thinking of the investment policy committee in a tremendously forward-looking approach. We went against conventional wisdom in some of the metrics, and that has actually panned out fantastically well for clients and for portfolios. As we head into the second half of the year, right, I want to focus on this last piece of this risk and uncertainty component, just simply down here focusing on consumer spending and labor market dynamics, kind of circling that individual component there. One of the uncertainties heading into the second half of the year is what's going to happen with the labor market and what's going to happen as a result to hiring, firings, and overall consumer consumption as a result of those dynamics. And we are starting to see some of those fundamental cracks. But cracks are not gaps. And I want to stress that in that the labor market has been extremely resilient heading so far into 2026 with amazing momentum from 2025. When we assess that on a forward-looking basis and look at how we're allocated to equities today, as part of our mid-July systematic restructuring and allocation changes across the platform, and as we head into year end, those will be into year end. The tactical and strategic allocation changes within the constituents of which equities were invested in, the how, the why, the when, the catalysts for shifting in and out are actually being revamped drastically as a function of how the labor market is going to respond and how it's already responding. We're trying to be 2 or 3 moves ahead of the labor market because it does have a very high significance to what's likely to happen to stocks on a 3-month lag. And that is an uncertainty that we're looking into right now. Lastly, on the risk and uncertainty piece, think something that panned out extremely well for us, again, in this crystal ball view, as I like to joke about. But then as we're heading into the second half, it's that policy and global trade piece. We have to play on the narrative of policy heading into a midterm election year here in 2026. As we get into the later parts of the summer, and as early fall starts to come into fruition, midterm election volatility has a very, very unique and repeatable seasonality profile every 2 years, right? Now, knowing that seasonality profile, number one, and knowing the labor dynamics that are likely to shift, and knowing the performance backdrop of that broader broadening of returns in the markets, we have a blueprint through year end to be able to play on that narrative. And what that may look like is slightly higher volatility profiles, okay? And those slightly higher volatility profiles are likely to be both in stocks and bonds, and higher trade policy volatility profiles as well to individual names. Therefore, the constituent, the equity selection backdrop heading into 2026 for the second half is going to be that much more risk-centric for us than it was in the first half. For those that have experienced the performance profile of our aggregate platform on the equity platform here in the first half, you'll see that the results are fantastic on a net of fee and net of tax standpoint, the tax alpha, the risk backdrop, the risk-adjusted returns. And we are pivoting in a way that we'll attempt to replicate that return profile in the second half. Yet we need to take new data into consideration, such as consumer spending, labor market dynamics, and policy changes and rhetoric tied to policy changes from the midterm elections. As always, we are behind the steering wheel on the investment platform, guiding clients through our life's most important events. And we will stay on top of this on a daily basis from a risk management standpoint and stand ready to provide an even greater experience on that front for our clients. Thank you.